Good morning, and thanks for joining Tecnoglass three-quarter call. We're happy to report excellent revenues, record 260.5 million, up almost double digits versus last year, with both segments contributing nicely, especially the commercial segment, which went up almost 12% year over year, despite the headwinds on the market and the broader industry. Adjusted EBITDA was in line more or less than last year. There's some headwinds that took place, especially as it relates to increased raw material costs for aluminum, U.S. aluminum premiums, and a stronger currency during the quarter. We're going to talk about that specifically a little bit farther ahead. Backlog continues to grow into a record level, now 1.3 billion, which is up 21.5% year over year. We'll talk about what is driving that continued growth despite overall market conditions. We took advantage of our very strong balance sheet and financial flexibility and went ahead and purchased 30 million worth of shares during the quarter. And the board just announced that it has approved an increase of his buyback program, of the company's buyback program, to 150 million, up from 100 million. During the quarter, we also closed on the refinance of our bank syndicate facility, going from 150 million to 500 million and expanding maturity to 2030. So right now, we don't have any short-term maturities and a significant amount of financial flexibility and availability under our credit facilities going forward. Moving on, the backlog, as I was mentioning earlier, 21.5% increase year over year to 1.3 billion. As we have discussed in the past, the backlog composition has shifted and is now comprised of higher-end projects that are less sensitive to interest rate fluctuations, especially high interest rates and high mortgage rates. And those projects give us visibility over a broader time horizon because those get executed. Those are larger projects that get executed, not typically on an 18-month time horizon, but typically on 24, 30-month time frame. So now we have visibility for 2026 and 2027. And that's why you see that the backlog conversion is lower than historical trends, where you would execute two-thirds of the backlog over the following 12 months. Now these are projects that get executed over 2 years and beyond mostly. Our book-to-bill ratio continues to be above 1.1 times. And now for the 19th consecutive quarter, we have continued to do that. So the company continues to take market share, continues to expand geographically, and continues to take advantage of its structural advantages, even in times of uncertainty. Moving on to the single-family residential slide, revenues were up to 113 million, to a new record for the quarter. Orders during the quarter were also up 21% year over year, so the dynamics there continue to work well. And again, is our core markets being, Southeast Florida being stable and new geographies contributing more and more. As we have discussed in the past, we have now opened up different showrooms throughout the U.S. And in Q4, we'll be opening up one new one in Los Angeles to support the West Coast area. And in addition to that, we also have our vinyl products that continues to ramp up and contributing to results. Moving forward to the next slide, the revenue bridge, as I mentioned earlier, up 9.3% year over year to a new record 260.5 million. Both segments growing, but the commercial segment growing higher at 12.3% as we continue to execute on that backlog. That segment is expected to continue, delivering nicely based on the visibility that we have on the backlog and the expansion that we have undergone and expected to continue having in new geographies throughout the U.S. Moving forward to the adjusted EBITDA bridge, different factors playing here. There's obviously, as we all know, very dynamic conditions in the US and different moving parts. We were able to increase pricing mid-single digits in Q2, and though that price increase is translated into Q3, into our P&L actually, now that the orders have been fulfilled and delivered. And that is essentially offsetting the impact on standalone export of products or standalone product exports, which carry a tariff into the US and is compensated for the need to buy US aluminum, which carries a higher premium in order to mitigate some of the tariff impacts that are being put in place by the US government. So the price is compensating for those factors, but then at the same time, aluminum has gone to an all-time high. So the LME pricing is higher than we had expected. And at the very same time, countries are having stronger currencies, many different countries throughout the world in comparison to the US dollar. As we have discussed before, we have an FX exposure about 20-25% of our cost and expenses being into the Colombian peso. And despite having hedged about 60% of our exposure, we're encountering headwinds on the 40% that remains uncovered. So that also impacted results this quarter. Finally, the labor cost with salary adjustments that were done at the beginning of the year, 9.5%. That is also a headwind when we compare the results year over year. But all in all, kind of on a nominal basis, stable results year over year. The other thing that is also playing a part here is that a lot more revenues are coming from the installation side, which carry a lower margin than what we saw last year. Moving on, balance sheet and capital allocation. We continue to generate a very strong amount of cash flow. We're expecting CapEx to trend lower the rest of the year, so the free cash flow generation is going to continue to increase. As a result of that, we're in a position with a net cash position as we have been in for the full year, but with a lot more financial flexibility given our recent refinance of our bank syndicate, going from 150 million to 500 million, all revolver structure. So we're in a position to reallocate capital in many different ways, including delivering cash back to shareholders via dividends and buybacks. And in that sense, the board just approved to increase the buyback program from 100 million to 150 million, out of which we have only used 53 million year to date. So that is another avenue to deploy cash back to shareholders. Finally, we're updating our outlook guidance for 2025. And now we're projecting revenues to be in the range of 970 to 900 million, which is approximately 10% growth year over year, with an adjusted EBITDA between 294 and 304 for the year, which is a growth rate of approximately 8% year over year. We're updating both ranges with better visibility now through year end. We're expecting slower light commercial invoicing based on everything related to macro conditions. We continue to see a stronger peso the rest of the year. This also incorporates a higher mix of commercial revenue, and mainly the increase in aluminum premiums and US aluminum cost, which has increased significantly quarter over quarter since we reported guidance last time. Based on that, and based on what we're seeing for the rest of the year, the backlog, and what we have already booked, and the opportunities that we see as far as geographical expansion and vinyl ramp up, we're also introducing the concept that we can grow revenues double digit again 2026, but we'll give you more color when we report earnings back in February again. So with that, we wrap it up, and we hope to see you to announce Q4 results. Thanks for joining.